of the week. It's March 1st, Wednesday, and we're going to be talking about the 10-year yield here. This is not the bond, this is the yield currently right now, and you can see on the screen that we've seen the bond yields really starting to rise sharply since bouncing off of support here back in early part of February. Basically gone vertical from about 3.3, and today we're hitting 4% on the 10-year yield. In fact, we could also look at this downtrend line was cracked just about 2 weeks ago, and again we came back down and tested that downtrend line over here and have been going up unimpeded all the way up towards 4%. We are pretty overbought here, and you can see here on the RSI at the top pane, but you know, there's a gap up here you can fill. Let's call it about 4.1 to 4.13 on the 10-year yield. So as yields are going up, we know bond prices are going down, and the reason for yields to be going up is because there's a lot of inflation in the system. The Fed is selling a lot of bonds right now, and we could have continued supply coming in as the Treasury also continues to sell more bonds as well too. There's just not a good risk appetite for fixed income here, and people more likely to sell bonds or buy fewer bonds than there are available. So you know, again, this is also, I mean, you can also trace out a very much of a W pattern, right? We always used to say W for winter, right? You see that we basically double bottomed here at the 34 level, or 3.4% from December down to February, and have bounced off of that, and it's continuing to play out. So the top level over here, of course, 4.3% came in October. That's when the markets were at their lows, right? And we'd certainly make a run up there towards 4.3%, especially if the Fed continues with their hawkish talk as they did this morning. And we have 4 Fed speakers on Friday. We have one tomorrow on the 2nd of March too. So it's not over for bond yields right here. If you you know, want to continue to look for fixed income, you might want to wait a little bit more to wait for those yields to climb a little bit more before you shift money into that. But let's make no mistake, the bond yields where they are right now are a huge competitor for equity returns. You have to ask yourself this: if the 6-month yield on treasuries is trading or selling at 5.1%, you can get basically a two-year yield. Prices are down that much. You can get a 6-month return of about 5.1%. Is that going to be better than stocks over the next 6 months? And if the answer is yes, you're going to see a lot more money flowing into bonds to capture that yield. So that's going to be it. Have a great day, everyone, and I'll see you guys next time.